Well, welcome to another Mortgage Minute with Art Alvarez. Yes, we're on a little early this morning. Art has some travel plans. He is delivering things from the North Pole to Mexico. So he has asked that we get on board early because his private sleigh leaves a little bit too soon. So with that, I'll bring Art in. Hey, Art, how are you doing today?
Hey Jeff, good. How are you?
Good. You all packed and ready to go?
Yeah, pretty much. I didn't. I don't have a sleigh though, so hopefully I'll still get there. So
Hopefully it'll make it still a smooth trip and everything will go well.
right.
Hey, the market news still seems to keep being positive for us. It seems like everything I read, there's from Barbara Corcoran to Johnny Cash. She's telling us it's time to buy a house and get off the sidelines. So I can't wait to hear what you have to tell us.
Yeah, there's definitely some more. I think the holiday cheer in terms of rates getting better is continued this week, so that's good.
The only thing that can make it better is if you have an unlimited supply of eggnog to get you through the holidays. Hey,
Right.
before I get off here, Art, I just want to remind everybody that this is a live show. If you have questions, please put your comments or questions in the comment section for Art. I'll be manning those and putting them on screen as necessary, and he'll answer them over here. And if you miss it, I can't believe you'd miss it, but if you do miss it and you're watching this recorded, do the same thing. Art will follow up as soon as his sleigh. I know he says he doesn't have a sleigh, but I think he does. He has a red sleigh that he drives, or excuse me, flies, and he'll answer those when he gets back. Art, let's have a great show. I'll be seeing you in a bit.
Okay, thanks, Jeff. Hello, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Welcome to this week's Mortgage Minute. As I was just mentioning to Jeff, the holiday cheer as it relates to the bond market and mortgage rates appears to be continuing this week. I've had some pretty good conditions continue after this pretty significant rate drop we've had in the last few weeks. So let's go ahead and get right into that. Of course, there's our rate grid where you can see all the rates available, and they're very low now. I mean, 30-year fixed conforming based on certain terms. 30-year fix as low as 6 1/8 with no points. FHA and VA now are kind of down in the mid fives, even jumbo loan down in the low sixes. So all looking pretty good. In fact, particularly what I like when I'm looking at this grid is the ability for a home buyer, if you're able to negotiate a temporary buy down, whether it's a 2-1 or a 3-2-1, you can, in these current conditions, you can get an interest rate first year in the low threes to low fours, which of course, that's what we're all hoping we can get back to sometime in the near future. I'm not sure we're going to get that low in terms of market rate, but still, you can kind of bring back the memories of 2020 and 2021 if you can negotiate a temporary buy down if you're out there trying to purchase a home, which I would encourage you to do. So in that respect, we'll take a look at the 10-year bond chart. The nice news there is it continues to be under 4%. We've had a little bit of an uptick today, but as you can see from this 5-day chart going back to last Friday, we're holding pretty well under 4%, right around 390. Earlier this morning, it was actually as low as 386. But all in all, this is a pretty good bond yield level, particularly given that today's economic news was primarily about initial claims for unemployment benefits actually was lower than expected, 205,000 versus 215,000 forecast. So that would imply the economy is pretty strong, which you would think that would cause maybe a little bit more run up in the 10-year bond yield than we're actually seeing. So I think that's pretty optimistically good news that things are going to hopefully remain relatively stable at these levels. So in terms of this week, and even going into last week, what would I want to talk a little bit about one of the things that triggered the enthusiasm and the increased positive news about rates, and of course the move we've seen in the 10-year bond chart, and that has to do with what's called the dot plot forecast chart. Now, what the heck is a dot plot? Well, what it's referring to is when the Fed meets, part of what they do, and they do this every quarter, is they ask each Fed participant official, which, by the way, there's a total of 19 people altogether, if you count the chairman of the Fed, Powell, the vice chair, the governors of each of the Fed districts, et cetera. There's a total of 19 people. So when they meet, one of the things they do every quarter is they ask each participant to put a dot on a forecast chart. And the forecast is about where is the Fed funds rate going to be at the end of each year? Well, earlier in the third quarter, that dot plot exercise with all the participants putting their dot on the chart, the consensus back then was by the end of 24, we would have one reduction in the Fed funds rate of 0.25%. That's not a whole lot. Well, it turns out now with the Fed meeting that just finished last week, now that dot plot chart is showing the consensus among these 19 individuals is 3 rate cuts of 0.25% each. That means a 0.75% reduction in total by the end of 24. So that's obviously better news. And that's, I think, a big part of why the market has reacted so favorably last week and this week is because of that dot plot chart and now the forecast of more rate cuts than was expected after the end of the third quarter. So with that, the rest of the week, not a whole lot going on. Obviously, it's Thursday before the Thanksgiving weekend. Tomorrow, though, we do have a pretty important economic data point that will be released, the PCE, or Personal Consumption Expenditure Index, that comes out on Friday. That is the Fed's preferred inflation indicator, and it is forecast to drop to 0.1 from 0.2 in October. So I think if that plays out, we should be able to see a bond market remain stable, these rates to not jump up or anything before we go into the holiday weekend. And generally on a Friday before a holiday weekend, things are usually pretty muted anyway. So hopefully that'll be the case. So in that respect, I think we're in a pretty good shape in terms of interest rates remaining stable and at pretty attractive levels. And again, I noted last week, it's kind of interesting to see this because we're simply back to June levels, but I think market participants are now getting a little bit more optimistic about it's time to go ahead and move on, go on with your life, try to buy a home, maybe sell your home if you're wanting to do that because the conditions are what they are. And if anything, it looks like the worst is over and we should start to see an improving trend. So with that, we're going to go on to something that's kind of interesting with these recent improvement in rate levels. There's something that is coming back, and that happens to be FHA and VA refinances, specifically the FHA streamline refinances and the VA IRRRLs. These are both refinance loan program options from HUD and from the Department of Veteran Affairs. And it's a refinance option that, as the name implies, particularly on the FHA side, it's a streamlined process. So there I've got some bullet points of what's involved. With an FHA streamline, you're refinancing an existing FHA loan. Now, it's important that you have to meet the 210-day rule and 6 consecutive payments. What does that mean? Well, that means is if you've gotten an FHA loan recently, you have to have had the loan for at least 210 days, and you will have to have made the first 6 consecutive monthly payments. So you cannot start the process. You can't even apply for a streamline until you've met those timeline criteria. Part of the reason it's streamlined is because there's no income documentation. We don't have to get an appraisal, and there's no minimum credit scores. So that's all good things and helps speed up the process and provides more homeowners the opportunity to refi into a lower rate. VA IRRRLs. Well, first of all, what is IRRRL? Well, it's interest rate reduction refinance loan. So obviously that's a mouthful. So we all in the industry, we call them VA IRRRLs. This is, again, a refinance of an existing VA loan. You do have to meet the same 210-day rule as well as 6 consecutive monthly payments. As with an FHA streamline, no income documentation, no appraisal required, and in most cases, no minimum credit score. So again, a very simplified, streamlined process. These can be arranged and closed pretty quickly. Now, it's important to realize you can't just do this for the sake of doing it. There has to be a net tangible benefit is required. So that is part of the loan process as we establish and determine if there is going to be a net tangible benefit to the borrower. And I've given you some examples here. On a fixed rate loan, the new rate has to be, generally speaking, at least 0.5% lower than what the homeowner currently has. If you're doing a term reduction, where maybe you're going from a 30-year loan to a 15-year loan, then the net tangible benefit test to be met requires that the payment for that shorter term not be more than $50 a month more than your existing loan payment on your longer term. A lot of cases, that's a little tough to meet, because when you go from 30-year loan to a 15-year loan, even though that 15-year loan may have a 0.5% or maybe more, 0.75%, maybe even 1% lower rate, that doesn't always necessarily mean that that new payment at that shorter term is going to stay within that $50 limit over what you're paying currently. So that one can be a little tough to meet. And then the other one that I'm showing here is if you're going from an ARM, an FHA ARM, to a fixed, the new rate on the fixed has to be no higher than 2%. And of course, obviously, what happens there is a homeowner who decides to go from an ARM to a fixed may very well and probably is going to be willing to accept a higher rate on the fixed, because it's more of a defensive move. They're looking to get out of that ARM loan, get into a fixed, because they want to avoid any future increases in that ARM interest rate. So again, those kinds of net tangible benefits have to be met. And so when I'm saying government loan refinancing is back, a couple of lenders we deliver loans to are making a big push to encourage these kinds of transactions. I actually have one lending source that I'm using where we can offer FHA VA or FHA Streamlines VA IRRRLs with rates at 5.5 to 6.25. So, 210 or more days ago, or 9 months ago, 12 months ago, 15 months ago, if you did end up getting an FHA loan on a purchase or a VA loan on a purchase, and maybe your rates in the very high sixes, touching 7% or above, these streamlined opportunities are real and can give you a definite benefit. So if you or anyone has gotten an FHA purchase loan, VA purchase loan in the last, call it 9 to 15, 16 months, and if they have interest rates that are currently very high sixes into the low sevens, these streamline and IRRRLs are a good opportunity right now. Give us a call, and we would be happy to give you some numbers for your particular situation. Now I'm going to bring Jeff back because we do have our Q&A session where we have an interesting question this week we'd like to cover.
Art, before we jump into that, just two things. As you were talking about these people who are sitting on the sidelines and now they're, it's like that pent up demand. It kind of reminds me of like somebody who says, okay, I'm going to go sit on a pole and not eat forever. Well, it's easy to say, I don't want that peanut butter sandwich when you're on your third day or second day, but now you're in day 80, day 90, all of a sudden, even a pack of peanuts looks very enticing. It seems like people are starting to realize, maybe this is the new reality and I'll take some peanuts and let's move on, huh? Well,
that's that, and Jeff, you're so good at coming up with analogies like that. I mean, again, I wish I had that kind of talent, but yeah, you're right. It's like home buyers, prospective home buyers or home sellers have been kind of like on a hunger strike, waiting for something good to happen. And even though where we're at now, which is considered good now, we were at in June, I don't know, it took a little longer on that poll to realize, it is good. And, maybe it's going to get better from here, but now's the time to act. So yeah, that's a good analogy. I think that very well describes where we're at, because we've seen more activity. It's starting to pick up. I think the market is capitulating and people are realizing we are where we are. It's time to get on with life and make things happen. So
I think that's great. The other thing is you were just talking about this streamlined financing, refinancing. Is it just me, or does that seem like a real no-brainer?
No, it is a no-brainer. And, of course, like in 2020 and 2021, when we had this, huge refi boom on first mortgages, the FHA streamlines and the VA IRRRLs were a big part of that. That's kind of like when we were talking last week about reverse mortgages, the core HECM product. Part of the reason the FHA HECM loan volume was so strong in 2020 and 2021 was HECM to HECM refis, going from one reverse mortgage to a new one to take advantage of the rate drop. And so, yeah, FHA streamlines, VA IRRRLs. We used to call them streamlines. Those are a no-brainer. If you're anywhere from 0.5% or higher up from current rates available, it's something you should definitely look at. It's easy to do, not a lot of qualifying criteria, and no appraisal. I mean, these things can get done very quickly. So,
wow. When you say very quickly, I mean, what are we talking? Less than 30 days?
Oh yeah, certainly. I would say it's certainly possible. Probably somewhere in the 15 to 20 day window, I think is very doable.
Wow. Make sure you call Art. He's at 760-883-5700. Today's question, it's kind of an interesting one. It says bridge loan. They've heard about. It says, I've heard the term bridge loan, but can't imagine it's a loan to buy a bridge, Art. What sort of loan is it, and what is it used for?
Yeah, that's a funny one because sometimes I'll get in conversations with people about bridge loans and tell them, hey, if anyone's trying to sell you a bridge or has a bridge to sell you, then I can help you with a bridge loan, which of course is a joke, folks. A bridge loan, though, I did want to talk about. It's a good question. I think there's not a lot of understanding of how it works. So I wanted to go over that. A bridge loan is basically a specialized product that, as the old saying goes, allows you to kind of have your cake and eat it too. And what I mean by that is you're a homeowner currently. You own a home that maybe has a lot of equity or might be free and clear. And you're looking to buy another home, and given where your market is and what your market is doing in terms of activity, you may have a need to try to acquire that home you want to buy and do so without the contingency of getting your existing home sold, even though that is your intent. You don't want to keep your current home, but at the same time, so you're going to sell it, but at the same time, you want to buy that other home and buy that now without getting that current home sold. And the bridge loan really is a product that serves that scenario where the homeowner of the current home who now wants to buy another home doesn't have adequate income to meet a debt ratio to be able to complete the purchase transaction while carrying the expense of the existing home. Even without a mortgage, we still have to carry the expense of taxes and insurance and HOA dues when you're trying to buy another home without having that existing home sold. So a bridge loan solves that problem. And basically the way it works is, and I've got one going right now. In fact, I'll use that as an example. I've got a client who owns a home currently, and it's worth about $1.1 million. They're going to list it for about $1.1 million. And they owe about $400,000 on the first mortgage. They're looking at downsizing. They're going to buy a home for about $680,000. So it's definitely a downsizing situation. But they want to complete that purchase while they're getting their existing home sold. And the bridge loan will allow them to do that. So in this particular case, the bridge loan is going to be able to be enough to cover the entire purchase price of the home being purchased. So in other words, we're going to be able to arrange a $680,000 loan amount that'll be used to purchase that home for $680,000. That bridge loan for $680,000 will actually, in this scenario, be what they call cross collateralized between the two properties. In other words, on the home they're selling, which has $400,000 owed on it, listing it for $1.1 million, a portion of the $680,000 bridge loan will be secured by the home being sold. And in fact, that piece can go up to 75% of that list price when added to that existing $400,000 first. So then the rest of the $680,000 bridge loan is then secured by the home being purchased. So if you think about it, folks, if you're buying a home for $680,000 and you're able to get a bridge loan for $680,000 because you're splitting that loan into being secured by both properties, you're actually getting 100% financing. So this is actually an example of how a bridge loan, along with a VA and a USDA loan, is or can be, in certain circumstances, a loan that provides you 100% financing for your purchase. Now, what you cannot finance is the closing costs. And the closing costs on bridge loans are not low. I mean, closing costs are high. Bridge loans generally are short term. They're typically 11 months, oftentimes provided by private money lenders. The interest rate is going to be high, generally around 10 to 11%. Mortgage payments are interest only. And the payments are only hopefully going to be made for a few months, literally 1 or 2 months, maybe 3 or 4. The whole idea is once you sell that home that you're departing from, then that will allow you to then get that bridge loan paid off. And therefore, you're only going to be making payments maybe, again, from 2 to 6 months, maybe more. That's why the term is set up for 11 months to allow you enough time to sell. So for that, a few months, yes, you're making an interest-only payment on what is considered a relatively high rate. Closing costs are also higher than typically than conforming loans, with these types of bridge loans, you're looking at probably 2 to 3 points plus some lender fees. So it is considered a higher cost mortgage. But if you think about it, the lender really isn't going to make much money on the transaction just from the interest rate for a few months. There's not enough return there. So they have to essentially front load their return for giving you this vehicle to, again, as I say, have your cake and eat it too, and get that purchase done while you're simultaneously getting your existing home sold. So for the right circumstance and for the right borrower, sophisticated borrowers in particular understand how effective this can be, because you're able to complete the purchase with really even with the high closing costs, really very little money out of pocket. And again, have that ability to close quickly while it may take you a few months to get your existing home sold. In this particular example I just described, the borrower's contribution to the entire transaction is going to be about $30,000. When you consider a $680 purchase price and you're only out of pocket $30,000, that's a pretty good outcome. And it's going to allow them to achieve their goals to get into this other home that they're downsizing sooner than later. So that's basically, Jeff, how our bridge loan works. It's a good product for the right situation.
Just one follow-up question. So you said this is designed to be a short term. So then within that time, so let's say in your case, your case study is they sell their home, and now do they pay off the other loan, or do they now refinance it and get a long-term financing on that? How does that work? Or does that give them the choice?
It'll be a choice depending on the particular borrowers involved. In this case, what will happen is when they sell their existing home, their departing residence, we call it, that's obviously going to pay off the portion of the bridge loan that was secured by that home. And it's around $350,000. So then the remaining portion that's secured by the home they bought, that by the time they sell their current home, they're probably already living in the new home. So when the old home is sold, that portion of the that portion of the bridge loan is paid off. And then the rest of the proceeds from the sale will then be applied toward payoff of the portion of the bridge loan on the home that they bought that they're now occupying. In some cases, the remaining sale proceeds will not be enough to completely pay off that other bridge loan piece on the home they bought. So they may have to contribute some of their liquid assets to complete that payoff shortfall for that piece. And in this case, my clients do have that money to do that. Although ultimately, we're going to look at giving them a refi on the purchase home so that they basically can get some of their cash back and use that for other purposes. So,
in that situation, as the homeowner who's using that bridge loan, let's say that the time lapsed is 120 days. It falls short of that 210 you talked about earlier about streamlining. Does that hurt them, or are there pieces you have in place to make that transition easy if they have to go to a new loan?
Now, are you still talking about the bridge loan scenario?
Yeah. So they still have money they owe on the bridge loan, but they have to they have to replace that in a period of time, right?
Well, yeah, but keep in mind the 210 rule, that does not apply to a bridge loan situation where you're going to refinance at the end of the sale of your existing departing residence and refinance your purchase property if you need to in order to pay off that piece of the bridge loan. The 210 rule doesn't apply. The 210 rule is specific to FHA Streamlines and VA IRRRLs, an entirely different product.
Gotcha.
Yeah.
Gotcha. Well, again, this seems like a great opportunity if you're thinking about, you found a place, or maybe you've had to move, or in this case, downsize. It's your choice. And you found that perfect scenario, but your home you're living in is not sold yet. It sounds like the bridge loan is actually not a bridge to nowhere, but a bridge to your new somewhere.
That's true. And particularly in this environment, as things getting more optimistic, rates have settled down a little bit. There does seem to be more activity going on in terms of people getting out there, looking at homes and wanting to get pre-qualified. What that's going to happen is bring back where we were not too long ago, where sellers are going to be hesitant to accept or consider even any contingent offers. Mm-hmm. So if you're in that predicament where you see a house you want, but you got a house to sell, if you got the equity sufficient to do so, a bridge loan is a great solution.
I love it. Well, I'm going to turn it back over to you because we have last week's closing question, but this is called a bridge loan. Again, if this scenario makes sense to you, get a hold of Art at 760-883-5700.
Thanks, Jeff. Yeah, this week or today, what I want to cover is last week's closing question. There it is at the top in yellow. I'll read it back to you. I'm a senior homeowner with a home free and clear of a mortgage. I've been considering a HELOC or a reverse mortgage to pull out some equity and found out that a reverse mortgage can include a HELOC. Is that true? Well, first of all, I'll tell you, I have encountered many times a senior homeowner with a home that's free and clear, and they have inquired about getting a HELOC or consider a reverse mortgage. So that scenario does happen. We do get inquiries like that from time to time. Well, the answer is, as I put on the screen, yes and no. A reverse mortgage does not have a HELOC per se. Now, again, a HELOC is a home equity line of credit. And of course, that is a second mortgage that is typically put on a home where there's an existing first mortgage in front of it. So the reverse mortgage doesn't have that directly, but what a reverse mortgage does include or can include is a line of credit, or what we call an LOC. It basically works the same way as a HELOC. Of course, the difference is, unlike a HELOC, if you get a reverse mortgage with a line of credit, if you draw on that line of credit, you don't have to make any payments against it. If you get a HELOC, you definitely have to make monthly payments, and that can be a deciding factor for a senior homeowner in the choice between getting a HELOC or getting a reverse mortgage that has a line of credit embedded in it. Now, how does the line of credit come up in a reverse mortgage transaction? Well, in a reverse mortgage, or more properly, a HECM, a home equity conversion mortgage, again, that's the core reverse mortgage product. It is administered or guaranteed, or actually insured by FHA. And when you get a HECM reverse mortgage, you actually will be presented with multiple ways to access the funds. And I've got them listed there in the bullet points. Of course, number one, there's going to be a lump sum amount. If you have an existing small mortgage being paid off, if you've got property taxes that are due, if you've got homeowners insurance is up for renewal at the time you're getting your HECM, those are kind of things that would have to be paid at time of closing. So that would become part of the lump sum. And you may want some additional cash in addition to what is called, the items I just described are called mandatory obligations. So if you want to get some money beyond the mandatory obligations that have to be paid at close, you would declare how much. And you can do that up to 60% essentially of the total loan amount available to you. Now, the other choices, though, are term payments. So you can choose to get a lump sum and then ask for the rest to be set up on where you get a monthly check for a specific term, let's say 10 years or 15 years. Another option is tenured payments, where you can get a lump sum at closing and then ask that the remaining portion of the reverse mortgage be paid out to you monthly for your lifetime. And of course, the monthly amount that will be calculated is going to be based on your life expectancy. And then the last way you can get access to the funds in the reverse mortgage is the line of credit, or LOC. So you can get your lump sum that you want or need to pay, plus whatever additional lump sum you want. And then if there is a remaining portion, you can ask that be set up on a line of credit. Now, there's something pretty unique. There's a unique feature about the HECM line of credit, and that is growth. In fact, I would argue this is the most attractive feature of a HECM reverse mortgage. The credit limit of a line of credit on a HECM grows over time. If you get a HELOC, it doesn't work that way. If you get a HELOC, your credit limit on the HELOC doesn't automatically just grow over time. It remains static. So as you start to use that HELOC, you could bump up against the limit and then you can't draw anymore. With a HECM line of credit, the initial limit is established based on whatever remaining portion is available after you've chosen the other access options. And then that limit over time grows. And what's happening now, which a lot of folks don't realize, in the higher rates that we've had the last couple of years, which have affected HECMs as well, those higher rates that we currently have mean that the credit limit, the LOC, line of credit limit, is growing at a higher amount, a faster rate than they were in 2020 or 2021. So the current higher rates actually is a benefit to reverse mortgage HECM reverse mortgage homeowners, because if they have a line of credit or they're getting one, it's going to grow at a higher rate over time because rates are higher. And this is why it's a good idea. You may have a home free and clear. Your mandatory obligations that have to be paid at time of closing may be relatively minimal. You might want to have a modest amount of cash at close, but maybe you don't really need a lot, and you don't want to have the interest accrue for money that's just going to sit there doing nothing. So this is why, in some cases, a homeowner will get a reverse mortgage, not because they need to access a lot of funds now, but they want to be strategic, get it in place with a large line of credit portion that they will leave untapped initially, but then understand that it's growing over time, so that at a later date, when funds are needed, maybe as they get older, they have more expenses related to their property maintenance and repairs, or maybe medical expenses as they get up, in years and have more medical services that they are in need of. That can come in handy because now you've got a line of credit that is larger than what it was when you first got your HECM reverse mortgage. And what that does is it provides you an increased financial security. So it was a good question. It's a great feature of the HECM reverse mortgage that I think a lot of folks don't really understand or realize. So that's why I always bring this up. It's a great feature. I think probably the best feature of a HECM reverse mortgage. And I just thought it would be a good idea that you understand that in case you're contemplating one. And of course, if you are, give me a call. I'll be happy to give you a proposal and give you some specific numbers. And with that, we'll go ahead and go on to our closing question for next week. And this is kind of an interesting one. On a conventional, actually, Jeff, this looks like the one, the header there on a conventional loan, will I get a better interest rate? That's not the question. Let me go ahead and read it to you. The last time I applied for a mortgage, I had to explain a few deposits on my bank statement. My account showed plenty of funds to close the purchase. So why did the lender want to know more about my deposits? As you can see there's the question. Again, keep in mind that I'll get into that in some pretty good detail. It is a frustrating point for a lot of borrowers. And so again, I'll give you the answer next week and it'll be on the house. Jeff, back to you.
Art, that I have to circle back to that line of credit for HECM reverse mortgage. That is a brilliant play. I like that for those people. It's like you said, hey, why not? If you're in a situation right now where you're a senior homeowner and you have a lot of equity or a free and clear, if I understand you right, I would set up a line of credit. That'd be my choice, to set up a line of credit with my reverse mortgage and just let it grow.
Well, exactly right. And see, I think that's one of the things about reverse mortgages that continue to be kind of a mystery to homeowners is it's got some really neat options. In a lot of cases, the access to the funds will be a multiple choice. It'll be, I'm going to get a certain amount of lump sum. In some cases, it has to be because maybe you have an existing mortgage that has to be paid off, and you have upcoming property taxes that are due, or a homeowner's insurance renewal. So even if you don't want any cash at all, oftentimes there'll be some amount of mandatory obligation that does have to be paid out of the proceeds. But in a lot of cases, that can be minimal. I'm getting ready to close one now where the homeowner only needs about $39,000 to cover their mandatory obligations and a little bit of cash, $10,000 that they want. What's happening to the rest of the money available to that homeowner? She's going to have a line of credit of over $350,000.
Very nice.
And over time, that's going to grow. So, by the time she needs it or wants to tap into it, it could very easily be $400,000, $450,000. To me, that's a huge, huge benefit that homeowners don't realize and that they should be aware of, because that could be a great way to get a reverse mortgage, even though you don't think you need the money.
Art, this is just another example of how working with someone like you with over 4 decades of experience in the loan and home financing industry, so many things that could help that we didn't even know it existed, like the whole bridge loan thing, and now the line of credit for a HECM. I mean, that is amazing. For those of you who are thinking, geez, I have a question, the best thing to do is pick up the phone and call Art at 760-883-5700. Now, if you want to talk, make sure you catch him while he's on his sleigh ride. Call him at his 714-612-9035. He does have sleigh-free dial or answering, so he can actually hands-free. He can still ride the sleigh or drive the sleigh, and he can answer your questions at 714-612-9035. Of course, always go to the website at mwloan.com. You can check out what's going on with the rates. The rate grid is always there, updated.
Mm-hmm.
More importantly, or just as important, there are a lot of tools below there. One of those is the mortgage calculator. You can kind of get an insight of, hey, where are you with some of this stuff? And of course, you can always send Art an email at art@mwloan.com. Art, I want to thank you for actually, all of 2023 of all the information you've given us, and I really appreciate you making a special accommodation today. I know you're tight on time and need to travel, but I really appreciate that. I want to wish you and your family and your loved ones a great holiday and safe travels. Next week, folks, we will be dark. We're actually going to take the week off, and then we'll rejoin you the first Thursday in 2024. Art, any last thoughts before we leave?
No, that's it. Keep in mind, folks, if based on what the Fed's talking about doing, if you are contemplating a HELOC, now's a great time. If we are going to have 0.75% decrease in the Fed funds rate in 2024, that's great for HELOCs. They'll ride down with them. Jeff, I want to wish you and your family a Merry Christmas, Happy New Year as well. And as well to all of you, our viewers, wishing you a great holidays, happy holidays, Merry Christmas, and a Happy New Year. As Jeff said, we're going to be dark next week. Hopefully the recent optimistic news in the real estate business is going to continue. Looking forward to even better 2024, where maybe we can all hope that Santa's going to bring us even lower rates that'll help get this housing market moving. So again, thank you for watching. Thank you for listening. And we'll look forward to seeing you week after next at MortgageWorks, where we have the answers and they're on the house. So long. Take care.